Financial considerations are arguably one of the biggest deterrents from sustainable construction practices in today's day and age. Almost all aspects about building sustainably tend to cost more, making financial considerations a popular topic and focus of sustainability plans. Hello, this is Mardel G. Berioso, and today, our group welcome you all to our presentation for the last topic for building system design, which is financial consideration, with the subtopics fundamentals of building cost and the life cycle cost. Since most of the technical concern for building system design, such as technical documentation, building envelope systems and assemblies, building materials and assemblies, as well as the building service system has already been discussed and introduced to us, we will now proceed to the financial matter. In the construction industry, one of the main challenges is managing building projects that have unique features and requirements. However, all projects have things in common: a scope of work, a time schedule, and a budget. Construction cost estimation is a fundamental skill for engineering firms and contractors, since important project decisions are based on cost. Buildings as results of construction projects are characterized by long lifespan and high cost. This fact is the reason why all decisions connected with construction project have long-term and significant impact. Construction project investors often focused simply on the acquisition cost when they were about to make decisions about such matters as building design, equipment, and energy systems. They frequently neglected future operation or maintenance cost. As a result of the loss of holistic view of true cost of a building, the cost-inefficient solution might be selected. Life cycle cost in general consists of initial investment and the follow-on cost, while some life cycle costing methods also include the cost of demolition. Life cycle costing is often recommended as the method for finding cost-optimal solutions for product design. It is generally becoming the more frequent used tool in the design phase of buildings. For further understanding about our topic on financial consideration, I'm now giving the floor to my other groupmates to discuss the topic on fundamentals of building cost and the further explanation for life cycle cost and their underlying subtopics. Thank you for listening.
Fundamentals of building cost. In the construction industry, one of the main challenges is managing building projects that have unique features and requirements. However, all projects have things in common: a scope of work, a time schedule, and a budget. Construction cost estimation is a fundamental skill for engineering firms and contractors, since important project decisions are based on costs. Construction cost means the total cost of the work to the owner of all elements of the project designed or specified by the design professional, including the cost at current market rates of labor and materials furnished by the owner and equipment designed, specified, or specifically provided by the design professional. It's not easy for construction companies to make accurate budget forecasts. There are many variables to consider, from market to labor costs and always fluctuating prices. But creating a detailed budget is a key to successful construction project management. One way to control your project billing is by defining the hard cost versus soft cost on a construction project. To create a realistic budget, you need to know the difference between these two costs. Hard costs are costs that are directly related to the physical construction of a building. These costs include the building materials and labor for construction. Examples are any material for the construction project, the building site, landscaping cost, and the ILEED certification for commercial real estate projects interior. While soft costs are costs that are not directly related to the physical construction of a building but still necessary to the property development, these costs include design, financing, and administrative expenses. Examples are architectural design and studies fees, land permits, service fees, rentals, equipments and tools, loans, accounting, finance and insurance fees, project management costs and taxes, advertising, marketing and public relation fees, LEED certification, and post-construction soft costs. When it comes to budgeting, hard costs are easier to estimate. They are tangible and revolve around labor and materials. Where labor and materials are not set in stone, those prices are less likely to drastically change. If they do, there are usually red flags that indicate their vitality, and you can address that in the budget. While soft costs can persist long after the project has been completed, some of them will be ongoing and regular costs related to maintenance and maintenance insurance. They can occur anytime in the life cycle of a project. It doesn't mean these soft costs are impossible to estimate and track, but they are definitely moving targets. Planning of the construction project is a multi-stage operation. Practically at every stage, from the idea of the project up to its full settlement, cost analysis are carried out. The accuracy of cost estimates improves throughout the design phase as the project is specified in greater detail. First, when there are no construction documents yet, only a broad estimate is possible based on the project scale and the type of facility. Second, engineering firms and contractors with experience in many projects can use historic cost data to improve the accuracy of preliminary estimates. And third, once the design process is complete, the construction drawings and technical specifications allow more accuracy. And there are two distinct tasks in estimating. First is to determine the probable real cost of the project, and second is to determine the probable real time to build the project. There may not be enough details in the project's specification when it is first drawn up for the client to fully understand what's needed. It is difficult to accurately quote a job when the job brief is still vague, and contractors won't be able to provide a fixed price. That is why prime cost and provisional sums are utilized to allow for gray areas to be priced. Estimators can make allowances that give the client some guide price. Prime cost sums is used to account for materials and/or subcontractors which have been specifically picked by the end client to be used on the project in whatever capacity they are indicated for. An agreed estimated amount is included at contract signing, but the specific products are not selected until a later stage. For example, if a client selects a more expensive door than allowed by the PC item, say a $500 door compared with a $440 PC amount, a variation will be required to cover the additional $60. If the PC item varies, so will the final contract sum. Provisional sums are amount of money included in the contract sum to cover work or materials or both, the extent of which cannot be specifically detailed when entering a contract. In some circumstances, unforeseen events mean that the provisional sum is exceeded, sometimes by a significant amount. This can be added to the contract sum. For example, a building site may seem sandy and clean with minimal site works required. However, there may be large limestone rocks or tree tanks concealed below the surface which only emerge once site work commences, causing a considerable cost overrun. Every real estate construction project has risks involved in the planning and the execution of the construction. The knowledge and practical experience of professionals such as architects, engineers, designers, contractors and general contractors, and government agency personnel help limit the risk involved in the project. The construction contingency is a key aspect of risk management protocol to ensure that the construction project can remain viable. Think of it as an insurance in the event of surprise costs or delays, which allow the project to still meet its commitments. Construction contingency refers to a percentage of money reserved to cover unanticipated construction costs or delays not identified in the budget or scope of work for the project. There are three different types of construction contingency. First, the owner. The owner construction contingency covers the costs that come with owner requests for changes to design, schedule, resources, and personnel, or a failure of one of your contractors to provide adequate personnel for the project. Think of things like adjustments to the construction plan to accommodate for unexpected environmental conditions, a change in funding due to cancelled or delayed government guarantees, or a failure of one of your contractors to provide adequate personnel for the project. And yes, professional independent review and the BOE should prevent such occurrences, but it is important to be prepared for anything that can introduce risk into the project. Second is construction. Your general contractor should discuss a construction contingency with you. This contingency gives the contractor the ability to adjust for and manage unexpected costs while still ensuring success. So it is important that you and your contractor agree that costs do fluctuate and that there is a degree of unpredictability in every project. And lastly is the design. While the design and materials are reviewed, analyze, and undergo value engineering, there might still be changes. This can happen, for example, when materials aren't available, scope creep requires changes to the design, or when general upgrades are required. The design contingency is used when the original budget didn't address project requirements, potential changes in market prices, and inaccurate project information available when the budget was developed.
Hi everyone, my name is Marinel G. Detera, BSCE-3B, and I am going to discuss cost planning as one of the topics under the financial considerations. So, what is cost planning? Cost planning is a technique by which the budget is allocated to the various elements of an intended building project to provide the design team with a balanced cost framework within which to produce a successful design. It evolves through the life of the project, developing in detail and accuracy as more information becomes available about the nature of the design, and then actual prices are provided by suppliers. Cost plans may include initial cost appraisals, elemental cost plans, approximate quantities cost plans, pre-tender estimates, contract sum, and final account. So let's start with initial cost appraisals. It is prepared during the feasibility study stage. They include client costs that may not feature in later cost plans, and as a result, will almost certainly need input from the client's finance director or financial advisors. Once the initial cost appraisal is completed, the client will decide the scope of cost that will in future be monitored by the cost consultant, and those that will be monitored and controlled by the client organization. Initial cost appraisals breaks down the overall project budget based on information provided by the client, an analysis of comparable projects, and the experience of the cost consultants. Next is elemental cost plans. Elemental cost plans are prepared during the project brief stage and carried through to detailed design. Elemental cost plan is a detailed cost plan which is broken down into a series of elements. Initially, the elemental cost plan will simply be the total construction cost for the project divided into elements on a percentage basis. The next one is approximate quantities cost plan. They are prepared from the end of detailed design through to tender. Approximate quantities cost plan is a development of the elemental cost plan. But unlike the elemental cost plan, in which the cost of elements is broken down from the overall construction cost based on the experience of the cost consultant and known cost of similar completed projects, of the approximate quantities cost plan is a first attempt to measure defined quantities from drawings. The next one, which cost plan may include, is PTE, or the pre-tender estimates. PTE are prepared alongside tender documentation. It is the final estimate of the likely cost of the works that are described in completed tender documents prepared to seek offers from the prospective suppliers. But take note that the pre-tender estimate itself is not included in a tender documents. The PTE provides a final comparison with the budget and along with the cash flow estimate enables the client to confirm that sufficient funds are available before committing to seeking tenders. And PTE also gives a basis for assessing and comparing tenders when they are returned. As with the tender documents, the PTE should be broken down into a series of packages even if there will only be one main contract. This will allow easy appraisal of tenders received. The PTE should be prepared following a standard approach to estimating such as that defined by NRM or the new rules of measurement. The next one is contract sum. Contract sum is the price agreed with the contractor and entered into the contract. The agreed contract sum should be calculated and checked very carefully as errors are deemed to have been accepted by both parties. However, the contract sum does not constitute a fixed price even if the contract is described as a fixed price contract. A truly fixed price would actually not be in the interest of the client as it would mean they could not make changes to the works. The last one is the final account. The final account is agreed once the construction works are completed. Preparing final account is the process of calculating and agreeing any adjustments to the contract so that the amount of the final payment can be determined. The cost plans mentioned are all pertain to the project's construction cost with the exception of initial cost appraisal. That would be the end of my discussion about cost plan. Thank you.
Cost estimates. Cost estimate is the calculation of the probable cost of a product or project based on information relating to the price of materials, labor, and etc. In cost estimates, there are methods that are being used on estimating actual cost. The first one is initial cost appraisals, elemental cost plans, the approximate quantities cost plan, the pre-tender estimate or what we call PTE, and the last one, the contract sum. The actual cost may change as the amount of detail available increases. So we move on to 5 types of methods for cost estimates. The first one is initial cost appraisals. Break down the overall project budget based on information provided by the client, an analysis of comparable projects and the experience of the cost consultant. Elemental cost plans. A detailed cost plan which is broken down into a series of elements. Initially, elemental cost plans, it will simply be the total construction cost for the project divided into the main elements of the works on a percentage basis. The approximate quantities cost plan. Unlike the elemental cost plan in which the cost of elements is broken down from overall construction cost based on the experience of the consultant, the approximate quantities cost plan is a first attempt to measure defined quantities from drawings or to take them off from a building information model. It presents a more accurate picture of where costs are distributed. In particular, it draws the attention of designers to those elements of the design that are standard and those are not, and as a consequence, may be more expensive. Approximate quantities cost plan should be accompanied by a schedule of assumptions made and perhaps a cash flow projection.
A pre-construction whole life cost plan may also be prepared. Approximate quantities cost plan should form a solid base for an effective value engineering exercise. The pre-tender estimate, or PTE. It is the final estimate of the likely cost of the works that are described in completed tender documents. It provides final comparison with the budget, and along with a cash flow estimate, enables the client to confirm that sufficient funds area available before committing to seeking tenders. It also gives a basis for assessing and comparing tenders when they are returned. If the pre-tender estimate exceeds the approved budget, an explanation should be provided for the client to consider and issue instructions. As with the tender documents, the pre-tender estimate should be broken down into a series of packages. This will allow easy appraisals of tenders received, which are likely to be prepared by contractors based on prices of packages received from subcontractors. The contract sum. It provides the first actual confirmed price. Up to this point, all cost planning has been on estimates. It is the agreed price of the contractor and entered into the contract. The agreed contract sum should be calculated and checked very carefully, as errors are deemed to have been accepted by the both parties. Bill of Quantities, or BOQ. It is a document used in tendering in the construction industry in which materials, parts, and labor and their costs are itemized. The quantities may be measured in number, length, area, volume, weight, or time. New Rules of Measurement, or NRM. It is where the best practice for the preparation of bills of quantities were stated. Most estimates are made up of the following 5 parts. Number 1. Materials. The estimator makes a takeoff of all the different materials required on the project from the plans and the specifications. Number 2. Labor. The estimator estimates the hours needed to the required work and then multiply by the appropriate wage. Number 3. Equipment. The cost of equipment includes ownership or rental fees, moving to the job site, erecting, dismantling, and operating. Number 4. Overhead. There are 2 types of overheads. The first one is the general overhead. Includes all costs that cannot be directly charged to any particular project, such as the cost of office supplies, rent, travel expenses, and salaries. The second one is job overhead. Includes all costs which apply directly to the project and cannot be charged to the materials, labor, or equipment. And the last one, number 5, profit. Most estimators show the profit expected from a job as a percentage of the total estimated cost of the project. The profit varies from 6 to 15%. Approximate profits usually expected are small projects 15%, medium projects 12%, large projects 10%, and the last one, very large projects 6 to 8%.
Good day everyone, my name is Joel G. Careso from BSCE-3B. My discussion is all about the construction cost and price indices. Construction price and cost indices are produced for use in estimating cost, checking, and pre-negotiation on public sector construction works. Price and cost are two ways of describing the same things. A seller price is a buyer cost. Building Cost Information Service or BCIS convention is to use price to means what a constructor charges as a client, and cost to means what a constructor pays for the materials, labor, and plant. The construction price and cost indices comprise the following. First is tender price indices. Second, output price indices, and the third, resource cost indices. Tender price indices or TPI. They measure the movement in prices agreed between clients and contractors at commit to construct, normally when the tender is accepted. These indices are typically used for adjusting estimates and budgets to different dates. Output price indices or OPI. They provide a measure of the average price of construction project currently on site. The movement in price paid by clients when the work is carried out. They normally reflect accepted tender prices in previous periods. These indices are typically used to convert construction output volume figures from current to constant prices, either for national statistic or construction program. Resource Cost Indices or RCI. They measure the movement in the cost of labor, materials, and plant to a contractor. These are generally the factoring case price for materials and plant, and nationally agreed wage award and statutory employment cost for laborers. Any difference between this cost and contractor's side cost brought about by market condition are reflected in the TPI. These indices are typically used for understanding inflationary pressures when preparing estimate and budgets and in inflation adjustment clauses in contracts. Example of RCI include the Generally Building Cost Index, the Generally Civil Engineering Cost Index, and the Price Adjustment Formulae Indices.
Hello everyone, I'm Russell Danza from BSCE-3B, and I'm going to discuss my topic about the capital cost and the operational cost. Capital cost. Capital costs are fixed, one-time expenses incurred in the purchase of land, buildings, construction, and equipment used in the production of goods or in the rendering of services. In other words, it is the total cost needed to bring a project to a commercially operable status. The capital cost of developments can include land or property acquisition, commissions, statutory fees, consultant fees directly associated with the development, materials, plant and equipment, labor, fixtures and fittings, project insurance, inflation, taxation and financing, and the internet costs directly associated with the development. Operational cost. Operational costs are the expenses which are related to the operation of a business or to the operation of a device, component, piece of equipment, or facility. They are the cost of resources used by an organization just to maintain its existence. The operational cost of developments can include wages, utilities, maintenance and repairs, rent, sales, and the general administrative expenses. In construction, capital cost and operational cost can be considered to be associated with separate distinct stages with capital cost during acquisition and construction, and then a handover to operational cost when the client takes possession of the completed development. Capital cost and operational cost can be seen as competing needs, with higher capital cost often resulting in lower operational cost, as a higher quality asset may have lower maintenance and repair cost, lower utilities cost, and so on. While sometimes, the division between capital and operational cost can be one of necessity, based on the resources available to the client at the time. It can be calculated decision based on assessment of whole life cost. That's all. Thank you.
Good day, I'm Ana May Briones and I will be discussing about life cycle cost and life cycle costing. So first, we will proceed to life cycle cost. What is life cycle cost? Life cycle cost is a financial technique increasingly used in sustainable construction analysis. It also examines varying alternatives that affect or impact the overall costs and savings of a process, product, or process over a given time frame. So LCC analysis depends on thorough understanding of the time value of money. So we have learned that time value of money is a concept that a sum of money is worth more now than the same sum will be at a future date due to its earnings potential in the interim. So, sa madaling sabi, life cycle cost represent the overall costs being spent during the building's whole life cycle, which includes the initial cost, the operating cost, the maintenance cost, the replacement cost, and the disposal cost. So the sole purpose of using the life cycle cost technique or calculating the life cycle cost is to compare high efficiency construction materials, systems, and designs with traditional alternatives that initially may be less expensive but have higher operational and maintenance cost. So for example is yung installation ng solar panels. So sa Philippines, the cost ranges from 160,000 to 900,000 and it has a projected life cycle of 25 to 30 years. So makikita natin sa table presented above yung comparison yung cost comparison ng paggamit ng solar panels and yung concrete rooftop sa Jakarta. So makikita natin sa table na ito that mas mataas ang life cycle cost ng concrete roof kaysa sa solar panels. So yan yung purpose kung bakit ginagamit ang life cycle cost technique. We'll now proceed to life cycle costing. Life cycle costing is a method assisting in estimating of the total cost of ownership and is useful for the estimating total costs in the early stage of a project. It helps make decisions within building investment projects. In other words, life cycle costing is a process of compiling all costs that the owner or producer of an asset will acquire over its lifespan. So the life cycle costing process includes planning of the life cycle costing analysis, selection and development of the life cycle costing model, and application of the life cycle costing model, and lastly, documentation and review of life cycle costing results.
Decisions in the life cycle costing process. Building and construction projects may benefit by use of the life cycle costing or LCC from the early stage until the end of the building's life cycle. The cost assessment contributes in making sound project decisions by considering not only the quality of construction technology and materials, but also the whole life cycle cost and environmental factors. The perspective of decision is moved from investment cost to the total cost for the life cycle of the building or constructed work. Hence, the life cycle costing may be viewed as a series of investment decisions. As discussed earlier, the lifecycle costing procedure includes parallel and interrelated phases. These phases includes the justification for investment requirements, conceptual development stage, design stage, production stage or construction stage, operational stage including maintenance, and lastly, end of economic life stage. By adding up the expenses for each stage, you can calculate the project's lifecycle cost. And this is its theoretical model which includes those stages. The utilization of a model like this should take place as early as possible and continue until the end life of the building. In this model, the horizontal axis represents the project phase and the time at which key decisions and lifecycle costing analysis need to be performed or updated. The vertical axis represents accumulative costs and costs of purchase and option within the lifecycle of a construction project. This also can be seen as the acquisition cost of moving from one stage to another within the lifespan of a construction project. Identifying, quantifying, responding, and managing cost and risk at each investment stage of a construction project could be a useful framework for comprehension cost and risk strategies. Conducting a lifecycle cost assessment allows you to predict how much an asset will cost you during its lifetime. The following are some of the reasons why knowing the lifecycle cost of an asset might help you make better decisions. First, in construction projects, you can either choose between two or more building designs or conceptualize and design a much better project. Lifecycle costing aids in decision-making at the conceptual development and design phases. If you only consider the initial cost of a project or construction work, you may end up spending more in the long run. For example, using low-priced materials might lower the construction cost, but it would cost you more in the long run in terms of maintenance and utility costs than using standard or higher cost but higher quality materials. By utilizing lifecycle costing, you can assess the overall cost of the project rather than just the initial cost, allowing you to make better decisions prior to construction. Next, it helps to determine the asset's benefits. Let's say you are intending to establish a rental apartment building. You can more accurately estimate if your rental business return on investment or ROI is worth the investment by using the lifecycle costing. Simply, if you only consider the initial cost and ignore the future expenditures, you will overestimate the ROI. And last, it helps to create accurate budgets. When you know how much the project will cost in total, you may create budgets that reflect your actual costs. If you underestimate the cost of the project, you may end up overestimating the money you save or earn if the project is for business. You may end up overspending or have a negative cash flow in your business if the entire costs are not properly taken into account. So in general, it is crucial to utilize lifecycle cost assessment or lifecycle costing starting from the beginning of the project and continuously update it at the end of each stage of the construction work. It ensures better decision from a more accurate and realistic assessment of revenues and costs, at least within a particular lifecycle stage. It's also important to remember that the lifecycle costing should not be used with the intention of decreasing the costs, but rather for ensuring the lowest cost over the lifecycle while fulfilling the performance requirements of the project. That's all. Thank you.